Thank you very much, and thanks for the opportunity to speak at this event. Well, it's been a spectacular year for the world economy so far, and as you can see from the title of my slides, although we've already had a really tough year, over the summer the sort of impression started to form that perhaps we were seeing a little bit of relief, and perhaps we were in for something of a recovery, and we've certainly seen that in the numbers. But I think the message that we want to deliver here is really that the path from here onwards for the next 12 to 18 months, we think is actually going to be quite tough. We think it's going to be quite a long haul in order for economies around the world to get back to some sort of semblance of normality. And that normality is going to probably look quite different to what we had before. So yeah, now for the hard part is the subtitle of my slides. But before getting into those comments about the recovery and how things have been looking better in terms of the economic data flow, I just wanted to start really by just looking back at the first half of the year and emphasizing just how much of a shock this was. We saw an unbelievably deep and broad global recession in the first half of 2020. We estimate that global GDP declined by 10% between the fourth quarter of 2019 and the second quarter of 2022. That's simply outside the range of anybody's stress test, really, of the sort of shock we might see over a course of years through a recession. And this happened extremely quickly. The depth of the shock, what I'm showing you here, is the second quarter GDP level compared with a year earlier. It's the year-on-year growth rate to the second quarter of 2020. And as you can see, there was indeed quite a bit of variation. We had a positive number in China, we just had another one for the third quarter for China, but everywhere else amongst our spectrum of major advanced and emerging market economies, we saw huge declines. So the breadth of this shock was huge, and there was some variation. We tended to see that the countries where the virus situation was particularly bad and the lockdowns that were employed to control the virus were particularly stringent. These countries saw a combination of a sharper than average decline in mobility. One of the sort of new data sources we've all been following on the global economy side is based on mobile phone tracking of footfall to retail and recreation venues, and countries that had more stringent lockdowns saw a bigger shock to mobility, and those also tended to be the ones with a deeper second quarter decline in GDP. So India, Spain, the UK all saw outsized declines. They had more stringent lockdowns than the US, and those lockdowns in some countries, some of those countries lasted a lot longer, including the UK. So there was some variation in the second quarter, but the broad picture, as I mentioned, is really just how far and wide this shock went. And it really didn't pay any heed to the prior position, the prior trend growth rate of an economy, whether an economy was an emerging market or a developed country, really made no difference whatsoever. In fact, the worst numbers that we saw amongst our portfolio of 20 major economies was in India, a 24% decline year on year. So the starting point for the recovery that we saw in the third quarter was really very weak. But although we had a spectacularly weak number overall in the second quarter, it was also a spectacularly short recession. I think one of the when we first started to think about how the lockdowns were affecting GDP, the comparison that we made, we were starting to see countries experience shocks to economic data that were consistent with a 20-25% decline in GDP. And that seemed to be happening almost instantaneously. Now, just to put that number into context, the entire peak to trough decline in the US economy through the course of the Great Depression was only 25 to 30%. And that adjustment took place over 3 years. We think, and we have spent a lot of time trying to estimate monthly series of GDP because we think it's pretty important to understand where the economy is right now. We have to look at it on a much higher frequency basis than usual. But our own estimate suggested that we saw absolutely precipitous declines in activity over the course of March and April. The peak, as you see on this chart, in the Eurozone down by 25%. In the UK, similar numbers, not as steep in the US, but still an enormous decline. But those declines essentially happened over 2 months and then stopped. And by the time we got to May, we were seeing things recover again. So essentially, it was a 2-month recession that we saw in the first half of the year. Again, completely unprecedented to have such a short recession and the economy starting to grow again from May and June. But those estimates that I've presented you there, official one for the UK, our own estimates for the US and the Eurozone, but you can see from the right-hand slide that they are backed up by the underlying data, and particularly the recovery in retail sales volumes in Europe and the US has been really quite impressive. We're now back above pre-virus levels across most of these major G7 countries, and that was actually something that was more rapid a recovery than we expected. Obviously, a big chunk of this has involved a massive substitution of online spending for offline spending, but it's the overall number that matters, and that has improved a lot, and that kind of speaks to the dynamics of this downturn that we saw, that a lot of it was about governments forcibly closing down businesses, forcing non-essential businesses to shut, including retail outlets. And once they reversed that decision and eased the lockdowns, we saw a pretty rapid rebound to the point where I think we're now of the view that the third quarter is probably going to see numbers that are a bit stronger than we're expecting across the board. So if we think about what this means for annual GDP numbers, you can see here, this is our forecast for global GDP. We see it declining by 4.4% in 2020 as a whole. So obviously a lot less than the numbers that we saw panning out in March and April, but it was a very short shock, and that explains it. But nevertheless, even with the recovery that we've anticipated from the third quarter, we still see global GDP down by 4.5%. That's twice as large a downturn as we saw in the world economy in the global financial crisis. In terms of the variations across country, you can see the US, we're now about -4, Eurozone's about -9. China, we're still of the view that China will grow by about 2.5% this year. But as I mentioned before, emerging markets outside China having a really tough time of it. And this average number is not driven by 1 or 2 countries. Across the board, we're seeing 4, 5, 6, 7% declines in GDP in 2020. So it's really outside the range of anything that we've seen for the year as a whole. We do expect a big bounce back in 2021 in terms of the year-on-year growth rate, but a lot of that is just simply about the weakness of the starting point, the base effect. We're starting from such a low level of activity in 2020 that even if there's any sort of progress towards normalization in 2021, that's going to translate into a strong year-on-year percentage growth rate, but won't take economies back to where they started with. To where they started, and that's what I want to come on to next, and to talk about the sort of the broader shape of the recovery that we are anticipating in the US and the Eurozone. There's been lots of discussion in the media about what letter of the alphabet best describes this economic cycle. Is it a V-shaped? Is it a U-shaped or an L-shaped? We're not really sure any of those letters. Even a K-shaped has come into the vernacular recently. We're not really sure any of those letters help you very much really understand it. And we think the probably better to look at your training shoes you've been running around the park in. Well-known brand of American sports shoes, or the Greek goddess of victory. We're calling it a swoosh-shaped recovery on our baseline forecast. And essentially that means that after this pretty quick recovery in the third quarter, in terms of the level of activity you can see on the panel on the chart here, we do see the pace of economic recovery slowing down very substantially as we get into the fourth quarter of the year. Now, in terms of sort of where we stand in terms of the incoming data since we published this forecast in early September, as I mentioned before, the initial V-shape, if you like, V-shaped pickup, if you like, is probably looking like it was a bit stronger. So an even sharper bounce in Q3 than we have here. But given the way the virus situation is going, which I'll come back to, maybe the fourth quarter slowdown is even more pronounced. So as I say, despite the strength of the numbers that we've been seeing over the last 2, 3, or 4 months on incoming data, this is our view. The US economy does not revert to its pre-virus levels of activity, i.e. the Q4 2019 GDP level, until the end of 2021. And in the Eurozone, we don't see the economy getting back to its pre-virus level until the end of 2022. And I just want to talk a little bit now about why we see this. Why do we see such a long haul going forward, given that initial strength of the rebound? The story essentially is one of an anticipation on our part that private sector demand will remain very, very much in the doldrums. A lot of headwinds on corporate capex because companies have suffered a huge revenue shock. A lot of them have had to take on a lot more debt than they were anticipating. And we think that one of the ways they will react to this shock is to be very, very cautious on business investment. Probably more important than that from a pure numbers perspective is the outlook for the consumer. We think consumers are going to be remain pretty worried about the job situation, and this is going to lead to elevated saving ratios. And this is related to very much to labour market developments. Now, obviously, in North America, in the US and Canada, we've already seen a huge shock to unemployment rates. They've gone up massively and started to come down quite sharply, but are still very elevated relative to historic levels. And one of the statistics in the US, which is causing us concern, is the share of the unemployed, which are now classed as being permanently unemployed, is rising quite sharply. So even though the unemployment rates come down, it's still very high by historical standards. More unemployed people are classified as permanent job losers. But in the US, in Europe, we see the unemployment shock is very much still ahead of us. Two factors have held down unemployment in Europe. One has been a large decline in the labour force through the confinement months over the spring, which is now starting to unwind. And secondly, there's been this massive short-time working subsidies. So governments have stepped up with job subsidies to allow firms to continue to keep workers on their books, and the government has supported these furlough schemes, which have been rolled out in massive scale. For the UK, Spain, Italy, France, Germany combined, at their peak, we had something like 30 million people on these furlough schemes, and that has acted so far to limit the rise in unemployment. But we don't think the European labour market can continue to defy gravity forever. We think as we get into 2021, it may be a little bit later than is shown on these charts, which are from our September forecast. Since we published that forecast, the number of these schemes have been extended. The data's come out again showing unemployment not rising as fast as we thought, but we still think this rise in unemployment is going to happen. And that's going to be weighing very, very heavily on consumers going forward. The other reason why we see the economy slowing down after this initial end of lockdown induced recovery is the sustained social distancing that we anticipate through 2021 as the virus has failed to be contained. And we think one of the easiest ways to think about this from a macro perspective is to look at it from a sector basis. We don't normally do this when we're building our macro forecast. We normally focus on the demand side, build things up from a picture of consumption, investment, government spending, etc. But we think at this point the production-based breakdown of GDP is interesting. And I've brought here on the left-hand slide the numbers for the UK. And what they show is monthly GDP, which is published in the UK by the official statisticians. They show us the sector breakdown of the shock that we've seen. And as you can see, the sector that we've labelled leisure and transport. So this includes transport and storage. It includes hotels and restaurants. It includes arts, entertainment, leisure. All the fun stuff, if you like. Tourism is in here as well. This is clearly the sector that suffered most from the enforced social distancing in April and has been the slowest to recover back towards normal levels, still 20% down in the UK as of August. And this sector, we believe, on our assumption that we don't get a sort of magic bullet vaccine solution anytime soon, we think this sector is going to remain in the doldrums. And it's a pretty sizable sector, as you can see from the right-hand panel here, accounts for something like 8 to 10% of GDP across the large European economies and the US. So we think that consumer caution, caution on business investment, and the direct impacts of ongoing social distancing, which will happen even if we don't get renewed nationwide lockdowns, is going to keep this sector very much in the doldrums. It's a very labor-intensive sector, so the weakness there is going to play into that rise in unemployment that we think is ahead of us in Europe as well, and is going to further drag down the economy. So that's those are the major headwinds that we see continuing over the next 18 months. But of course, we have had really what's been a totally unprecedented level of macroeconomic policy support. So on the fiscal side, we estimate that globally, we are seeing direct fiscal easing of around 8% of GDP. It's even bigger in the advanced countries. It's more like 11% of GDP. This is much more aggressive than we saw back in 2008. It's been accompanied by a rollout of sovereign guarantee schemes, backed up by central bank liquidity support as well, which I'll come on to. And it's really been absolutely huge in scale and very rapid in the speed with which it's been rolled out. And this is going to continue to support the economy for at least some time. We expect there'll be more stimulus coming in the US. That's not included in this chart. We've had announcements of more fiscal easing at the European aggregate level as well. And this is on such a large scale that even if you don't think the elasticities are very large, and there's actually good reasons for thinking they may be fairly sizable at the moment, it's so large that it's clearly going to make an important difference. And it's one of the reasons why we do factor in continued growth going forward. And of course, we've had an equally spectacular response from central banks in terms of the interest rate cuts that we've seen across the board in the US and across emerging markets as well, but also the massive expansion in central bank liquidities. We think something like $6 trillion of new QE purchases in 2020 as a whole. That's half of the entire QE purchases that we saw over 2010 to 2019. So absolutely enormous response from the central banks. And it's clearly made a very big difference. I think essentially it has prevented a tightening in credit conditions from occurring. Normally, when you have a large economic shock, it becomes amplified by a tightening of credit conditions. The central banks have managed to stop that happening. We've actually seen a pickup in lending growth in April and March in the US and Europe. Corporates have been borrowing more money. And of course, it's made a big difference globally, including through the Fed swap lines, which have unblock the dollar shortages that we saw in late March, and has allowed risk assets to rally quite spectacularly, seeing emerging market bond spreads come back down very sharply, which in combination with the decline in treasury yields, has been a very important offset of the possible risk of a tightening in global credit conditions. So global financial conditions have not have been pretty supportive of the economy, and have certainly not amplified the downturn in any way. And I think that's because of the strength of this policy response. We think central banks are fully prepared to go a lot further if they feel they need to. I think at this point, the Fed feels the expansion in its balance sheet that was seen in the last few months has gone far enough. They can carry on at 80 billion a month, but they don't feel they need to ramp it up from that. But if they were to become fearful of the pace of recovery and achieving their inflation goals, they would certainly be more than willing to ramp this up again. And indeed, the change in their framework has certainly increased that dovish bias. So central banks have been acting and continue to act, I think, like they're really not very constrained about medium-term inflation fears. So that is obviously a very important offset as well, and again is something that's been driving our forecasts. Nevertheless, I sort of want to end on something more of a cautious note by starting with the good news. The good news is when we look at China, we have actually seen a proper V-shaped recovery there. The level of GDP is now something like 7% above where it was at the end of 4 or 5%, sorry, above where it was at the end of 2019. So the economy has, in that sense, has fully normalized, and it seems to be growing at a pretty rapid pace again. 5% year on year in the third quarter, up from 3%. And the numbers that we saw yesterday were actually quite encouraging in terms of the path of growth through the quarter. So September showing an acceleration relative to July and August for industrial production, fixed asset investment, and indeed retail sales, which had been lagging through this recovery. So a good story from China, but in a way, the lesson from China, I think, is actually a fairly sobering one for the rest of the world, which is sort of, I think China is showing us that unless you contain the virus, you're not going to get a full economic recovery. And I think having started talking about this slide in very positive terms, I actually think it's a fairly humbling chart from the perspective of the rest of the world, where the virus is clearly not being contained. And if I come on to that, I want to just highlight these virus trends, which obviously we've all been watching. You're all aware of these numbers. It's more than a second wave. It's like the first wave never really ended. I mean, and certainly we're seeing now in Europe new daily cases well above the earlier peaks, and that's also been true in the US. But one thing I think to bear in mind is that this recent resurgence in virus cases has not been accompanied by anything like the falling off of a cliff in the number of new virus cases in the daily mobility data. This is the right hand slide here. Daily mobility absolutely plummeted in March and April as the crisis struck sort of almost out of nowhere. This time round, the US, we haven't seen any real deterioration since the summer in mobility, so visits to retail and recreation outlets. And while there has been a deterioration in Europe and the UK, it's not been anything like what we saw back in March. So you can't really draw a straight line between the number of new virus cases and what it means for the economy. The response to this recent resurgence has still very much been a lot more targeted than what was seen back in March and April, when we had these nationwide, highly stringent lockdowns. All non-essential businesses were closed down. It's not gone as far as that. Now, clearly that is a very significant risk. This is quite a dynamic situation as we speak. More and more restrictions are being rolled out, and we could easily get there where we get back to full nationwide restrictions. If that happens, I think there's definitely a downside risk to our forecast if that happens. We'll just have to wait and see. But at the moment, we're not seeing and and this is pretty high frequency data. We had this up to a few days ago. We're not seeing the impacts on the economy look anything like as severe at this point as the lockdowns that we had back in March and April, but a very important downside risk. So as I say, we will have to see. But one thing that we do think is worth pointing out is that our expectation is that there is a semi-permanent really impact from this crisis. It's such a big shock that we expect potential GDP to be affected by the crisis, and it's easiest to see in terms of this chart, which shows the forecasts that we're making for US GDP, the recovery that we have, and we're comparing it to the path that we expected the US economy to be on before the virus. So back in December 2019, this was how we saw the 5-year outlook, this blue line. But now we see the red line. We do recover, but we don't actually get back to that pre-virus trend. We've actually got the level of GDP permanently reduced by 3 to 4 percentage points relative to the pre-virus trend. So we do see scarring as a result of this crisis. And the final point that I want to make, because I think it may be quite relevant in your part of the world, is just what's been happening to world trade. Because this was quite a big worry for us at the start of the crisis. We saw a bigger decline in GDP than back in 2008, and we expected that world trade would probably fall faster than it did back then for the same reason. In fact, the declines in world trade have been about on a similar scale to those that we saw in 2008, down by about 10% year on year. At the trough, but if anything, the evidence is now starting to show that it's coming back, and so it looks like it's going to be broadly comparable to what we saw in 2008, despite the fall in GDP being that much deeper. And I think there's a number of reasons behind that. One is that this is a crisis that's affected the services sector disproportionately. So I'm looking at trading goods here. This is more related to the manufacturing sector. China's obviously recovering. That supply chain disruption in February has been unwound. So I think that's been helping. As we've been into lockdown, we've seen a few consumption patterns that have been quite striking. Electronics, consumer durable sales have been strong. Asia is very much specializes in that area. China's exports of electronics have held up well. China's exports of medical equipment have held up very well. But I think also a part of this is related to the financial and the credit side. What happened in 2008 that we saw trade credit drying up everywhere. That hasn't happened this time, as far as I'm aware. So, picture on world trade, very poor, but not quite as bad as we expected. So I think I'll probably stop there and see if we have any questions.
Thank you so much for your presentation, Mr. Coulton. For the Q&A section, let's welcome Alexander Quesada, Market Development Manager for the Panama Stock Exchange.
Thank you very much, Acer, and thank you very much for the presentation, Mr. Coulton. Certainly refreshing to hear about the recovery and that not everything might be doom and gloom going forward. We will now begin with the Q&A session, where users may write their questions via the platform's questions module. En este momento iniciaremos formalmente la etapa de preguntas y respuestas a través del módulo de preguntas de la plataforma. And we have the first question coming in from you, Mr. Coulton. How would a vaccine discovery and distribution affect the economic outlook?
Thank you. Yeah, I mean, maybe I'll answer that by just articulating, what we are assuming in our global forecasts on the medical front, and then how a vaccine might change that. So the assumption that we've made in these forecasts that I've just presented to you is that economies essentially are able to avoid a renewed wave of nationwide lengthy lockdowns, and that's the basis on which the numbers. We can. Can you hear me now? Is that better? Okay. Yep. So, sorry about that. I was hearing scary echoes of my voices. So the assumption is that we avoid renewed nationwide lockdowns, but that there isn't any major breakthrough on the vaccine front, certainly in the first half, certainly not before late 2020, 2021. And what that will mean is that even though we're not assuming countries go back into full lockdown, that there will be sustained voluntary social distancing, if you like, which will affect consumer spending and will affect those sectors that I mentioned in terms of tourism and transport. Now, in the event that we were to get a vaccine discovery soon and it was able to be distributed on a very wide scale basis, and there was strong take-up, if it reached the point where essentially the health crisis was no longer sort of front and center of everybody's daily life, then I think there is potentially a significant upside to the forecast that I presented to you. But as we're not experts on this, but as we've looked at the evidence and the predictions that the scientists come up with, it seems to us that that's probably more of an upside to our 2022 forecast than necessarily our 2021 forecast. It does seem quite a stretch at this point to imagine this happening quickly enough to sharply boost the speed of the recovery in 2021.
Fantastic. Thank you, Mr. Brian. Next question would be, what kind of impact can the result of the US elections have on our region?
Yeah, this is hard to say. I think one of the most significant changes may be if we were to get a Biden victory, the approach to international trading relations by the US may become a little bit more, should we say, likely to operate within the sort of more traditional multilateral channels that we've all been used to before this current US administration. So less volatility, less concerns about sort of, announcement shocks where we might see, threats of the imminent imposition of tariffs on particular countries for justified by various reasons. I think that has been something that's been quite disruptive. We had the episode with Mexico for a while. Obviously, that got resolved. So I think the approach to international trade relations, I don't think it will necessarily change that much on the US-China front in terms of I wouldn't expect to see any sharp change in tariff policy from a Biden-led administration, but I would expect the WTO to play a greater role. There'd be a more multilateral pressure on China to make the changes that are seen as necessary. My understanding is that there might be more progressive and constructive dialogue on immigration as well. I do think that some of the financial market volatility that has been associated with quite an aggressive unilateralist approach to trade, would be something that would benefit the region. I think maybe just one other point. I think our expectation as well is that there's probably be greater fiscal support over the next couple of years in the US if we were to see a significant ramp up in spending. So that might, all else equal, be a factor in stronger US growth. Obviously, very important for the region. on the other hand, there could be a different approach to corporate taxation. So yeah, it's quite hard to really draw a strong conclusion about the outlook for the US macro economy. I actually think the virus dynamics and the response to that is probably going to be far more important for the near-term US economic outlook. So I think it's probably the broader trade impact that we would see as more significant.
Okay, thank you very much. On one of your slides, this is a question that was sent. On one of your slides, you mentioned retail sales. Is that referring to online sales? And how do online business can help to, quote unquote, get back in track?
Yeah, the numbers in the slides are aggregate retail sales data, so they include online and offline. So majority of that is offline traditionally, but we've seen a massive increase in the share of online. I think in the UK, for instance, the share went from 22% to 32% in the space of 1 month. Has recently gone back down again slightly, but is much higher. To some extent, this was sort of a forced adjustment. I mean, the shops are closed. Where else are you going to get the stuff from? But I think that was very much only in the midst of the sort of confinement stage of the crisis, and so maybe things have the online share of sales has fallen a bit over the summer as lockdowns have been eased. But we very much of the view at Fitch, I think that this is probably a long-term evolution as towards more online sales has been kind of permanently accelerated by the crisis. So we're not going back to where we were before. I think even if we get an effective medical solution, I think online has kind of proven itself very much in this crisis, and there's going to be a ratchet effect here. So yeah, so the numbers in the charts are for both. So if you think about offline sales are probably still pretty weak. I haven't seen these numbers, but it just shows you how massive the increase in online sales has been. I mean, absolutely enormous. And I don't think this is going to be reversed. I think there's a step up here. So this is just a new reality. I think that the retailers are going to have to get used to across the world.
Completely agree with this new normality of online sales as you were referring to. We have several very interesting questions coming in. One of them being, do you consider that globalization as we know it will cease to exist?
I think cease to exist is probably a bit strong, but we'd already seen that the pace of globalization kind of peaked in sort of early 2010s, I think, really, sort of maybe 2013, 2014, 15. I think that the sort of share of world trade relative to world GDP, that was when the peak really occurred, and it already started to go sideways. A lot depends here, I think, on the outcome for the election, but I do think the US-China relationship is now very much in a different place. I think even a Biden administration would feel that they need to keep the pressure up on China. I don't think we're going to be seeing the sort of ongoing integration of China-US production chains. I think that at best is going to slow down, quite possibly be reversed. So I do see globalization is going to be in a gradual retreat. I think that's the base case over the medium term. It will still be significant, though. I mean, the scale of the interrelationships in global supply chains has reached such a high level. There's so much cross-border investment now that this is not going to go away overnight. I just think at the margin, it's probably going to be going in the other direction. We're probably going to be seeing net some sort of reshoring of production. I don't think it will be dramatic, but I think that's the direction that things are going. This crisis has increased, if you like, the focus on inequality, which has been an important sort of political economy development in the last few years. I think one of the ways that will affect policy will be, you know, trying to encourage more manufacturing jobs in the advanced countries. I think that seems to be a broader policy trend.
Fantastic, thank you. I think we have time for just our last question for this session. The lack of global mobility impacts about 30% of global GDP, which will not be improved at least during the first quarter of 2021. How do you see that impacting the numbers?
Yeah, I mean, we've looked at all these various mobility data quite closely, and the series that we found to be most important and the best lead indicator of what actually happens to GDP is this retail recreation series that I have in my charts. And as you can see, that's gone back to it's not as far down as 30% below normal levels. That may be true if you look sort of individually at you know, say air travel, for instance. But if you look at this sort of mobility more generally and its impact on GDP, it's the retail recreation stuff that matters most, and that has recovered. But I think it's that leisure and transport slide that I showed you. Maybe I can go back to this slide briefly. I don't know if I'm still sharing that. No, I don't think that's going to work. But yeah, it's the tourism component there, which is not the biggest. Doesn't account for all of the 8 to 10% of GDP, but yeah, this is certainly a big enough sector to have a permanent macroeconomic effect on outcomes over the next 18 months. But it doesn't preclude the sort of gradual recovery that we are forecasting. We still think that can happen while mobility remains severely constrained.
Well, thank you very much. This has been a fantastically enlightening session. Although there are more questions, we have ran a little bit out of time. So we would like to thank you, Mr. Brian Coulton, Chief Economist for Fitch Ratings. It's been a pleasure to have you share your thoughts about the global economic outlook, which specifically this year has certainly been anything but normal. Queremos agradecerle enormemente al señor Brian Coulton, Chief Economist de Fitch Ratings. Ha sido un placer que nos comparta sus opiniones acerca del panorama económico global, especialmente este año, donde absolutamente nada ha sido normal. Muchas gracias. Thank you very much.
Thank you.